The decision to sell 80% of a physical silver position is not presented as an impulsive gesture, nor as a break with the precious metals market. From the outset, it is framed as a deliberate move within a broader capital reallocation strategy. The approach does not stem from a loss of confidence in silver as an asset, but from a comparative assessment between different forms of exposure within the same sector. The narrative is built around a central idea. Precious metal cycles do not express themselves uniformly across all instruments linked to them. Physical silver serves a specific function within a portfolio, primarily associated with value preservation and protection against systemic risk. However, at certain moments in the cycle, other vehicles may offer a different balance between risk and return without departing from the same universe of real assets. The partial sale of silver holdings is therefore presented as a tactical reduction, not as a total liquidation. Retaining a meaningful portion of the metal preserves direct exposure, while freeing capital creates the opportunity to position in segments where operational leverage can amplify the effects of a bullish precious metals market. The decision is framed within a reading of the current environment, characterized by rising institutional interest in natural resources and early signals of a broader commodity cycle. From this perspective, the action is not described as a short-term price call or reaction to recent market movements. It is positioned as a structured response to an environment in which capital seeks efficiency within a single investment theme. The emphasis is not on abandoning silver, but on reorganizing exposure to align with what is perceived as the next phase of the precious metals cycle. The reallocation of capital from physical silver toward mining equities is grounded in a specific logic that distinguishes between the function of the metal and the behavior of the companies that produce it. Within this framework, silver is not challenged as a strategic asset. Rather, it is acknowledged that its performance does not always fully capture the opportunities that arise during certain stages of the precious metals market. The explanation rests on the structural difference between owning a metal and participating in an extractive business. While physical silver reflects market prices directly, mining companies incorporate additional variables that can significantly influence valuation. These include margin expansion, operational efficiency, and earnings sensitivity to relatively small changes in the underlying metal price. This characteristic gives mining equities a distinct profile within the same market environment. From this perspective, the move does not represent an indiscriminate increase in risk, but a conscious selection of exposure. Capital released from the sale of silver is directed towards specific mining companies chosen for their ability to benefit from strength in precious metals. The decision is presented as a way to position in assets that have historically responded with greater intensity when metals enter a sustained expansion phase. Confidence in this approach is tied to a broader market reading, in which precious metals are not viewed in isolation, but as part of a cycle involving both physical assets and the corporate structures that produce them. Within this framework, investment in miners is understood as a strategic complement, not a full substitute for the metal, aimed at capturing performance potential that direct silver holdings alone may not reflect to the same degree. The analysis then expands to incorporate the behavior of central banks, whose role is essential to understanding the context in which reallocation decisions within the precious metals sector are made. The material describes a clear and consistent pattern. Monetary authorities across multiple countries are increasing their gold purchases while simultaneously reinforcing their commitment to retain existing reserves. This process is not presented as isolated or confined to a single region. Participation by numerous central banks, including Serbia, is cited as part of a broader trend reflecting institutional preference for gold as a reserve asset. Accumulation is not driven by short-term tactical considerations, but by a sustained strategy unfolding across jurisdictions. The narrative emphasizes that these decisions occur even as the US dollar remains the dominant global reserve currency. Continued central bank demand for gold is therefore interpreted as an adjustment in reserve priorities, rather than an immediate replacement of the existing monetary system. Gold is treated as a component that complements and, in some cases, balances exposure to currency-denominated assets. Within this framework, gold accumulation is described as a deliberate strengthening of sovereign balance sheets. Central banks are not only acquiring the metal, but choosing to retain it, reducing their willingness to part with reserves in an environment perceived as increasingly uncertain. This institutional behavior provides important background for understanding why, during the same period, some investors view it as appropriate to adjust exposure between physical metals and other sector-linked assets. The sustained increase in central bank gold reserves is linked to a gradual erosion of confidence in the US dollar. This loss of credibility is not described as an abrupt collapse, but as a slow deterioration reflected over time in reserve allocation decisions. While the dollar maintains its dominant role in the international financial system, monetary authorities are adjusting exposure in response to factors that generate uncertainty about its long-term stability. These include perceptions of erratic policy, fiscal fragility, and the repeated use of economic instruments for strategic purposes. Together, these elements have introduced doubts about relying on the dollar as the sole reserve anchor. The analysis cites concrete data to illustrate this shift. The dollar's share of total central bank reserves has declined from approximately 66% a decade ago to around 57% today. This reduction does not signal abandonment, but reflects deliberate diversification toward assets less exposed to political or financial dynamics. In this context, gold emerges as an institutional response to reducing dependence. Not tied to the economic policy of a single country or to unilateral decisions, the metal provides a means of cushioning risks associated with excessive concentration in one currency. This logic explains why, as confidence in the dollar weakens, gold accumulation intensifies as part of a long-term defensive strategy. Within this institutional framework, gold is characterized as an asset with a unique function in official reserves, a universally recognized store of value free from political affiliation. This quality is central to understanding why central banks consider it essential amid financial and geopolitical tension. Unlike fiat currencies, gold does not represent the liability of any sovereign issuer. Its value does not depend on monetary policy decisions, regulatory changes, or bilateral agreements. This independence makes it a neutral asset, capable of retaining recognition even as international relationships deteriorate or economic priorities shift. This neutrality explains its historical and contemporary use as a value reference among nations with differing political and economic systems. Today, central banks turn to gold not as a speculative tool, but as a stabilizing element within their balance sheets. Its inclusion reflects the need for an asset insulated from sanctions, trade disputes, or external discretionary decisions. By highlighting these traits, the narrative reinforces that gold accumulation is neither fashionable nor tactical. It is presented as a structural choice grounded in confidence in an asset that preserves its essential role regardless of economic cycles or political climate. This institutional perception provides key context for understanding why demand continues to rise among sovereign actors. Institutional accumulation unfolds alongside a significant rise in gold prices. The material notes that gold has reached record levels, trading near $4,643 per ounce, with expectations that it may surpass $5,000. This move is framed as a direct reflection of financial and geopolitical strain. The price increase is not attributed to a single factor. Instead, it is linked to combined concerns about market stability and growing international volatility. In this environment, gold's performance is interpreted as a response to demand for assets perceived as safe havens. The analysis avoids framing the rally as speculative. Rather, it situates price strength within a trend supported by institutional decisions, particularly sustained central bank demand. Elevated prices are viewed as a consequence of gold's role in sovereign balance sheets rather than short-term market behavior. These high price levels reinforce gold's perception as a core reserve asset. Far from deterring demand, record valuations are presented as consistent with a strategy focused on protection and stability, even at historically elevated prices. Gold is explicitly described as insurance within official reserves. This characterization is based not on return expectations, but on its ability to preserve value in instability. Central banks are incorporating gold as protection against risks that cannot be mitigated through traditional financial assets. This insurance function corresponds to a global environment marked by persistent geopolitical tension and recurring market volatility. Gold provides a reserve independent of financial system functionality or counterparty trust. Its holding is interpreted as preparation for adverse scenarios rather than a directional bet. The material highlights that this logic has prompted many central banks to reassess not only how much gold they hold, but where it is stored. Accumulation is accompanied by decisions aimed at ensuring physical availability, reinforcing that gold's value lies in possession rather than accounting representation. From this perspective, gold becomes a resilience component in sovereign balance sheets. Its role as insurance is reflected in the willingness to hold it even when other assets may offer higher returns. This priority underscores its strategic function in an increasingly uncertain world. The gradual displacement of the dollar in reserves is presented as a measurable process. The dollar's share has declined from roughly 66% to about 57% over the past decade. This quantitative change reflects structural adjustment. The reduction does not imply immediate replacement. The dollar remains dominant, but its relative weight has eroded through deliberate diversification. This behavior reflects the need to distribute risk in an environment where fiat currencies are subject to political and fiscal decisions. The shift is global, not regional. As the dollar's share falls, other assets gain weight, with gold playing a prominent role. In this context, reduced dollar dominance is interpreted as institutional caution. Central banks are not abandoning the dollar, but reducing exclusive dependence. This adjustment reinforces gold's stabilizing role by offering an alternative not subject to fiat currency dynamics. With no clear fiat alternative, gold is presented as the primary diversification option. Currencies, such as the pound, euro, yen, or yuan, lack the neutrality, scale, or universal acceptance needed to replace the dollar credibly. These structural limitations enhance gold's appeal. Unlike currencies dependent on issuer stability, gold's recognition is independent of ownership. This positions it as a common asset where central banks can reduce vulnerability without shifting risk to another currency. This preference arises not from distrust in a specific currency, but from the absence of consensus on a replacement. In this gap, gold offers continuity without requiring a new monetary system or exposure to block tensions. Thus, gold consolidates as the leading diversification asset. Its role is not to replace the dollar, but to balance a system lacking a universally acceptable fiat alternative. This diversification manifests in a tangible shift. Gold surpasses the euro to become the second largest global reserve asset after the dollar. This reflects a meaningful reconfiguration of reserve structures. The shift is cumulative, not event-driven. Gold's rise over the euro reflects preference for neutrality rather than euro-specific weakness. Gold offers independence that fiat currencies cannot. This confirms gold accumulation as structural rather than defensive. By occupying a central reserve position, gold reinforces its role in the global financial system. Surpassing the euro symbolizes long-term adaptation, prioritizing stability and independence. Alongside accumulation, reserve repatriation reinforces gold's strategic nature. A significant share of central banks intend to move gold from foreign storage to domestic vaults, prioritizing direct control. This is not a short-term reaction, but part of broader risk reassessment. Repatriation ensures sovereign access in financial or political stress. Location becomes as important as volume. Roughly 2/3 of central banks plan or have begun repatriation. Countries such as India, Hungary, Turkey, Poland, and Germany exemplify this trend. Repatriation reinforces gold as ultimate security. Domestic custody enhances response capacity. Physical possession underscores gold's role beyond accounting value, as a pillar of financial sovereignty. Major accumulators are identified as countries exposed to geopolitical and financial uncertainty. Official purchases rose about 10%, led by Poland, Kazakhstan, Azerbaijan, and China. This behavior is interpreted as coordinated risk response. Gold strengthens sovereign balance sheets through independence from external obligations. Despite this, the United States remains the largest holder, with over 8,000 tons, maintaining its historical role even as others accelerate purchases. Together, established holders and new buyers illustrate gold's central role. Concentration among geopolitically sensitive countries reinforces its function as structural protection. The analysis concludes with a clear institutional projection. Central banks are expected to continue accumulating gold at an elevated pace throughout 2026. This is not speculative, but a logical extension of observed trends. Continued purchases are driven by persistent uncertainty, diversification from the dollar, and lack of credible fiat alternatives. The likelihood of reduced gold exposure is limited. Beyond volume, intent is long-term holding. Accumulation aims at balance sheet consolidation in a structurally unstable environment. Retention confirms gold as a security pillar. With this outlook, gold reaffirms itself as a central component of global financial architecture. Expectations of sustained demand in 2026 close the analysis by highlighting a deep, lasting shift in reserve priorities, where stability and financial sovereignty dominate.